Micron just crossed $1 trillion in market capitalization, 19% in a single session. While retail chases Nvidia headlines, institutional desks have been quietly rotating into the next phase of the AI infrastructure buildout. This isn't a momentum trade, it's a structural inflection point that separates smart money from dumb money. Let's dissect what's actually happening beneath the surface. We're now 3 years into the AI stock market boom, and the narrative is shifting from software hype to hardware necessity. Micron's surge isn't isolated. It's a symptom of a broader semiconductor supercycle that's entering its second act. Memory chips, the unglamorous workhorses of AI data centers, are now the bottleneck. Every large language model, every inference workload, every edge deployment demands exponentially more high bandwidth memory. Micron, Western Digital, and SK Hynix are the oligopoly controlling this choke point. But here's where it gets interesting. The AI buildout is no longer confined to Magnificent 7 tech giants. Look at BOE Technology Group, a Chinese display manufacturer that just rallied 30%. Why? Because they pivoted into supplying specialized components for AI server infrastructure. This is the playbook. Old economy firms with manufacturing scale, capturing AI infrastructure alpha. Smart money is hunting for these conversion stories in small cap tech, companies with established supply chains that can pivot into AI adjacency. Reuters reported institutional capital is now actively screening for small cap US tech stocks with credible AI exposure. The pattern is clear. We're moving from phase 1, software and hyperscaler dominance, to phase 2, infrastructure and component supplier re-rating. Now let's zoom out historically. This rhymes with 1999, but not the way most people think. Everyone remembers the dot-com bubble bursting in 2000, but they forget that between 1997 and 1999, the real winners weren't the flashy internet portals. They were Cisco, Corning, and JDS Uniphase, the infrastructure providers laying fiber and building routers. Cisco peaked at a market cap of $550 billion in March 2000, not because of irrational exuberance, but because every enterprise needed networking equipment. The parallel today, Nvidia is the Cisco of AI, but Micron, TSMC, and ASML are the Corning and JDS Uniphase, the picks and shovels plays that institutional portfolios are now overweighting. Here's the tactical insight. Micron's rally is confirmation that memory pricing has bottomed and demand visibility extends through 2027. This is a signal for derivative plays. Applied Materials and Lam Research, semiconductor equipment makers, should see order backlogs expand as memory fabs ramp capacity. Ticker-specific opportunities, MU, AMAT, LRCX. These aren't speculative bets. They're positioning for a multi-year capex cycle that's only beginning. But there's a darker undercurrent. Wall Street is hanging near record highs, and oil prices are easing, classic late-cycle dynamics. The Nasdaq just hit fresh all-time highs driven by tech, yet breadth is narrowing. This is the exact setup that preceded corrections in July 2007 and January 2000. Smart money is hedging this divergence by rotating into quality infrastructure plays with tangible earnings visibility, rather than speculative AI software names trading at infinite multiples. The antitrust blind spot is also critical. ProMarket just published research showing financial markets are underpricing regulatory risk for big tech. If memory demand is concentrated among 5 hyperscalers, and those hyperscalers face antitrust scrutiny, the entire AI infrastructure thesis could reprice violently. This is why diversification into Asian semiconductor supply chains, Taiwan Semi, Samsung, matters. They have geographically distributed customer bases and lower regulatory risk profiles. So where does this leave us in May 2026? The AI supercycle is real, but it's evolving. The easy money was made in 2023 and 2024 on Nvidia and Microsoft. The next phase requires surgical precision, identifying which infrastructure components are supply constrained, which old economy firms can credibly pivot, and which small caps have institutional sponsorship. Micron crossing $1 trillion is not the top. It's the starting gun for phase 2. But only if you understand the difference between momentum and fundamentals. Dumb money chases the headline. Smart money bought the memory downturn in 2023 when prices were depressed and inventory was clearing. That's the edge. Disclaimer: this analysis is for educational purposes only and does not constitute financial advice. Always conduct your own due diligence and consult with a licensed financial advisor before making investment decisions.